Good afternoon. Welcome to the latest edition of TigerHawk TV, barely rehearsed, totally unedited. The subject today is the financial crisis, as it's been in the last couple. I've had to put together a presentation for a bunch of our employees at my company on the history of the financial crisis. There's a chunk of it that I think is of general application. So I'm going to go through these PowerPoint slides, and if it stays under 10 minutes, which is the YouTube limit, I'll post it up for your comment. There's a lot of generalization here. There'll be a lot to quibble with. It's a superficial take, but I'm hoping you'll find it interesting. So what's going on? Well, the crisis is the result of the popping of a bubble. It's one of many in history. Capitalism has gotten through these before, and it will again, but this one's the first that's truly global in nature. Everyone's blaming the United States because the first sector to blow is the subprime mortgages, but it could have started somewhere else, and I think that's just sort of easy anti-Americanism. The background's a global explosion of debt and liquidity over the last 25 years. This drove wave after wave of asset price bubbles that burst, one after the other. People remember the NASDAQ bubble, the telecom bubble, the various real estate bubbles, oil and other commodities, even the euro. All have burst. Jim Cramer says there's always a bull market somewhere, but really that's not true right now. There are no bull markets. So what caused all of this? Well, that's a very controversial question, and historians will argue about it for a long time. Today you'll get no clear answer because there's a lot of it will drive a lot of regulation, however the consensus emerges. But I think there were three sort of big culprits that acted in symbiosis. One's the Fed, which kept money too cheap for too long, especially after 9/11. The second is the feedback loop between American consumers and Chinese savers, which you'll sometimes read wonks who call this chimerica. And the third is 25 years of financial innovation that massively changed American business, global business, and increased debt. And that's the main area of focus. So why did that happen? Well, in the old days, lending was confined to banks and other conservative institutions like insurance companies. I call it old school lending. Banks lent about $11 for every dollar of equity. So growth in lending, or debt, was limited to the growth and retained earnings of banks. Money was expensive. Loans only went to strong borrowers. I call this the Mr. Potter model, after Mr. Potter and It's a Wonderful Life. Banks had all the leverage. They controlled access to capital and kept the value of all assets low because people could not spend more money than they had. Starting in the 1980s, though, non-bank lenders began to change the picture dramatically, and it had a tremendously favorable effect on global economic growth. Michael Milken and Drexel Burnham invented original issuance junk bonds, which made it possible for companies that were not investment grade to bypass banks and go to investors directly. Salomon Brothers invents the mortgage-backed securities market. You know that if you read Liar's Poker. Asset securitization, this ability to tap into small loans, or relatively small loans, spread from mortgages to cars to consumer credit. I actually worked on the first consumer credit card securitization, and eventually corporate loans. These were all bought by a new group of investors, including foreigners who had to recycle the dollars they collected because of our national trade deficit. New school non-bank investors, as I call them, would lend at much higher rates of leverage than banks. They would lend $30 for every dollar in equity they had. And that created an enormous oversupply of credit available, and it shifted the balance of power from lenders to borrowers. Mr. Potter was done. And it, for a while at least, seemed like it was indeed a wonderful life. But by 2006, it seemed that anybody could borrow for any reason. No documents, no down payment. Basically, if you had a pulse, you could get a mortgage. And all that easy money drove up the prices of everything, including especially real estate, all over the world, the U.S., Europe, everywhere. Unfortunately, prices can't rise faster than the economy grows, not for long. Subprime mortgagors began to default. When teaser rates expired and people couldn't make the new higher payments, That drove down the value of mortgage-backed securities. And then people learned that leverage goes both ways. So these non-bank lenders began to lose money. And for every dollar of losses that they suffered, their lending capacity shrank then by $30. There was a massive contraction in lending capacity. They started selling fixed assets to repair their balance sheet, selling, asset-backed securities. Nervous investors demanded their money back. That triggered more selling. Mark-to-market accounting referencing depressed market prices for these securities caused even more losses, more selling. And then there was a run on AIG's credit default swaps, which were a form of bond insurance. People were worried that that wouldn't be worthy, so that's caused more selling. The contagion then spread to the banks, who, after all, lent to the non-banks? The banks and the commercial paper market. Commercial paper is short-term obligations. The principal investors in commercial paper are money market funds. Well, you, me, and everybody put their money in money market funds. That was fine for a generation. Money market funds seemed as good as gold until this September. Lehman Brothers failed. The reserve fund, old long-standing money market fund, owned a lot of Lehman paper, and it broke the buck, meaning that it had to reduce the net asset value of shares in its fund to below $1. That triggered a run on money market funds, and the commercial paper market disappeared. Corporate borrowers all had to turn to their banks all at the same time, and they all hit their bank lines at once. Some banks could fund it, some couldn't, but the interbank market became paralyzed because banks with capital to lend didn't know who they could safely lend it to under the circumstance of this simultaneous demand for credit all over the world. The result of all of this is that trillions of dollars in lending capacity literally vanished in a matter of days or weeks in September and October. A huge proportion of non-bank capacity it just was crushed. Every dollar of losses wiped out $30 of capacity. The commercial paper market vanished. Interbank lending ended. The government then stepped in. The Federal Reserve guaranteed commercial paper. It bought some. It guaranteed interbank loans. You know about the TARP program, which put up eventually $700 billion in new capital for the banks. But that wasn't enough to stimulate new bank lending into the real economy. Why? The forced liquidations have been continuing. All of these non-bank lenders are dumping their perfectly good assets, in many cases, onto the secondary market. Banks have been able to buy them, and because the prices are so depressed, they've been able to get much higher rates of return on these secondary loans than they could by originating new loans. And so the result is that the recovery of the secondary market to rational pricing is a prerequisite, a first requirement for the banks then to begin new lending to new borrowers. There is progress. Interbank lending's back because of all these guarantees. The commercial paper market's much improved for the same reason. Prices in the secondary market for loans, junk bonds, and convertible bonds have been rising since mid-December, a fact we've reported on this blog. And so there is a light at the end of the tunnel. The question is it an oncoming train? Now we've got a big problem with the quote-unquote real economy, and the concern is that that will result in more defaults. Markets and regulators fear another wave of forced liquidation and a return to the cycle of violence. That's why the markets are so jumpy. So finally, why didn't regulators prevent this? Well, you're going to get a lot of argument over that for all the same reasons. There's a vested interest in the answer, but my opinion is it's because bull markets are too much fun. Nobody wants to stop them. No politician ever in history has stopped a party in the middle. The only defense against bull markets at the end of the day, against huge asset bubbles, is human memory. And I think that's why Japan's getting through this crisis in pretty great shape. it went through its own ridiculous asset bubble in the 1980s, and people there have remembered what happened. So I expect the next disaster in around 50 years, when the last people who live through this one are the grumpy old men and women saying, well, you know, you shouldn't lend money so much, and the people in charge say, no, it's different this time.